Welcome back to another episode of What Works Wednesday. I'm your host, Leland Gross, and today I want to talk about the 3 ways that investments make money. Because I get a lot of misconceptions or misunderstandings around this, and I think people understand I invest my money to make money. But how that actually works and how different investments work together and why you use different investments doesn't really compute to a lot of people. But it's honestly very simple. There's 3 kind of main ways that investments make money. The first is dividends, second is interest, and third is appreciation of the value of an investment. So let's break down each of those 3 things and then we'll talk about, how to think about that. So number 1, dividends. First, when we choose investments, we choose either equity or debt holdings, which don't get too caught in the weeds on that. Equities would be stocks, which is ownership of a company. If you own a share of Apple, you are part owner of Apple. Now, you might be a very, very fractional owner, but an owner nonetheless. So you get to reap the reward of owning a company. Which for dividends, that would be, hey, we've got profit. Apple decides, hey, this year we made so much money above our expenses. So we've got profit and we're going to distribute that to the owners. So everybody who owns a share of Apple is going to get X amount of money when we give out dividends. So dividends are a share of the profit of a business. So a little check sent to you because you are part owner. Now, most of the time that hits your investment account and you reinvest that. You don't have to reinvest it. It's a setting. You could have them just send it to you. But most of the time, you're just going to reinvest it, meaning you get that dividend check in and it's, $50 and you just repurchase more Apple stock or more other investments using that $50. So that's a dividend. It's a share of the profit of a company distributed to you because you are part owner of that company as a reward as the owner. Next is interest. So we talked about equities. Now there's, debt holdings where you are essentially giving a loan to either the US government in the form of a bond or to a bank in the form of a CD or a high interest savings account where you're saying, here, you hold my money. And they say, great, we will pay you interest to hold your money. And how that really works, the contract you're signing is they are free to use that money as long as you are able to recuperate your money with interest after the set amount of time. So for high interest savings, they can use your money, but if you need that money, they have to be able to give it back to you with interest. Or with a bond or a CD, you say, hey, you can have it for 6 months, for a year, for 3 years, 5 years, 10 years, depending on the length of the security, the debt or treasury note. And they say, great, we get to use this money for that amount of time to fund, the US government or the bank or whatever initiatives they have going on, but they're going to pay you interest because they're essentially taking a loan from you. I know that's confusing. That's not how we think of when we think of savings or CDs or bonds. We think of it as I'm going to save money and get interest for it. But really, the contract is I'm going to give this money to this institution. They can use that money how they need, but it's safe. They're guaranteeing that they'll be able to give it back to you in whatever amount of time with interest. So that's how interest works. Interest is kind of like the dividend of banks and of debt obligations. Dividends are kind of like the interest of stock holdings. So they're, check amounts that come to you because you've invested your money. The last is appreciation. And I think this is the one that people don't really think of. It's, capital gains, things like that, where let's go back to the fact that you own stock. Well, you own Apple stock. And let's say when you bought it, Apple was worth, $100 a share. And then let's say you sell it in 5 years, but Apple's come out with all these great products. Apple's grown as a company. They've created new service lines. And so now Apple as a company is worth more. So your $100 share can now be sold for $125. So you paid $100 for the share of Apple, but now you can sell it for $125. And so that is appreciation. You just made money on that because the stock has appreciated in value. This is similar to like real estate. You buy a home, your primary home for $300,000, $500,000, you sell it for $700,000 because over time the value of the home went up. That is appreciation. And you pay only capital gains tax on appreciation, whereas you pay income tax on interest, which is a higher tax. Capital gains are at a lower rate. And with dividends, it depends. There's ordinary dividends and qualified dividends. Ordinary dividends are taxed at ordinary income rates. Qualified dividends qualify for capital gains treatment, so they get actually a little bit of a benefit there. So those are the three ways we grow money. So when we're investing, we're looking at dividend income, interest income, and overall appreciation. Those three together will create what's called your total return. What's the total amount you put in and what's the total amount you receive? And the way you need to think about that is risk reward. So we know this with stocks. If I'm going to take more risk, if I'm going to invest my money, give my money to a riskier institution or a company that, may or may not make it or may really swing for the fences and grow a ton or may fail, I, as an investor, expect a bigger return. So high risk, high reward. So most likely going into a riskier stock, you will get a bigger gain on the stock if it doesn't lose. Again, higher risk, higher reward. If I take less risk, I shouldn't anticipate getting as big of a reward. Because if I go into a really stable company, not going anywhere, not really trying to grow as much, they're just, generating profits, I probably won't get as much appreciation because they're not really trying to grow, but I might get more dividends because they're a stabilized company with high profits. They're not reinvesting their profits to keep growing. They're probably willing to distribute it, get more dividends. And with interest, you're not taking risk, right? With stock or with bonds and CDs, those are safe investments. They're not high risk. You're getting a contract where you're going to get paid back. So as opposed to saying I might lose my money, instead the reward comes from tying up your money over a longer period of time. So if I'm going to give you my money for 6 months, I better get a bigger interest rate than if I give it to you for 3 months. Or if I give it to you for 10 years, US government, I'm going to buy a 10-year bond. So you have this money for 10 years. I better get a higher interest rate than if someone gives it to you for 3 months and they're not really taking that much risk with it. Now, I qualify that by saying for the last, year or two, we've been in an inverse yield curve, which is finance 2.0. We're not going to go in deep into that, but it's where short-term interest rates are higher than long-term interest rates because interest rates rose quickly. But in general, that's how we think about it. The more risk you take or the longer you're willing to go without the money with, debt obligations, the higher your return will be. The less risk you take, the lower your return will be. On average, that's just how an investor thinks. So the market has been poised to reward people for taking bigger risk or holding out for a longer period of time. So this is how our money grows, whether it's real estate, whether it's stocks, whether it's bonds. This is how these things work, is the more you're willing to take risk, you'll get, either more dividends, more appreciation, or more interest. And the less amount or the least willing the less willing you are to take risk or tie your money up, the less return. Checking and savings accounts, you're not taking any risk and you have immediate access to the money same day. There's not going to be a reward, so you're not going to get interest on your checking or savings account. So these are all things we experience as investors, but not always things that we think about. Or when it comes down to, what I hear a lot is, how much interest did I make on my investment portfolio? And I look and it's all stocks. I'm like, you didn't make any interest, but you're not really asking about interest. You're asking about growth. But your money is in stocks, so it grows differently. It grows through appreciation and dividends, not interest. But that's just an education piece. So I hope today served to educate you on how money grows, how we can be thinking about it in order to gauge how much we should be making and what we need to do that. As always, if you have any questions, don't hesitate to reach out and go forth, build the life you long for by growing your money well and prosper.